Welcome to Trading Nation. I'm Brian Sullivan, and we're joined today by Aswath Damodaran. He is professor of finance at NYU Stern School of Business and considered one of the leading valuation experts out there. Aswath, good to chat with you again. Thank you very much. Before we get to the overall markets, Tesla, trader favorite. Is the stock overvalued?
Let me back up. I think there are two games going on with Tesla. There's the pricing game, which obviously is driven by mood and momentum, and that's been pushing Tesla up. There's a value game, and I'm going to surprise you. While I wouldn't buy Tesla at 295 or 300, there are plausible ways of getting there. I mean, it's not a slam dunk overvaluation from that perspective, but to get there, it's going to take some work. I mean, here's what they have to do. They have to deliver about $100 billion in revenues in a decade. They've got to be able to do that while delivering tech company margins and investing like a tech company. Can they pull it off? Well, some people seem to believe they can. I am skeptical, but I think there is a way to get to that valuation.
Walk us through that way then.
Okay.
I know that Jim Chanos, very famous short seller, been right a lot more than he's been wrong. He is very skeptical of this.
Okay. Here's what they need to do, right? I mean, in a sense, they're an automaker. Ultimately, cars have to roll off assembly lines. If what they have to spend to build those assembly lines is what a typical automobile company spends, there is no way they're worth $50 billion. They have to spend way too much to scale up from 100,000 cars, which is roughly where they are now, to 1 million plus cars, which is where they need to be. Here's what Elon Musk is promising people. He's saying, I found a new way. In fact, he talked about machines building machines. We haven't seen any of this in action, so that's why I'm skeptical. But at the same time, given Musk's history of being able to pull off the impossible, I wouldn't put it past him. I mean, there might be a new way of building cars that he's really come up with. I haven't seen it yet, but that is the basis for the $300 stock price.
All right, pretty interesting view there on Tesla. Now, last week overall, Professor Robert Shiller of Yale, I'm sure you know who he is, probably know him personally, told us that valuations are so high, the market has become a little bit dangerous. Here's what he said. Listen.
It hasn't been this overvalued except a couple times in history, around 1929, around 2000. We're above the 2007 valuation. Right now is a good time to look at one's portfolio and ask if it's diversified enough. You know, there's Europe over there, there's Asia over there, and I think most Americans are not well diversified globally.
Okay, what are your thoughts, Aswath?
Well, the part of it that I agree with is we should all be more diversified. But the part that I don't get is, how is diversification going to protect you if there's a market crash? If the market crashes in the U.S., it's going to crash we're all linked up at the hip. It's not the 1980s where the U.S. market can be down 40%, the European market is going to be up 10%. If we're going to crash, we're all going to crash. Being diversified is not going to bail you out. That said, I think I heard...
Well, could it minimize it, though, Aswath? I mean, I don't think he's saying it's going to bail you out necessarily, but mitigate some of your losses, if we get that.
Not really, not if you're in equities. The only way you can mitigate your losses is by getting almost entirely out of financial assets. And I think that's the reality we face since 2008, is unlike the old days where you had geographic correlations that could help you, or maybe one class of equities did well when another did not, I think we're all correlated to the point that if you had a major crash, it doesn't matter what your portfolio is going to looks like. If it is 100% equity, you're going to feel it. So the only way out of this is to take your money out of stocks and put it into cash. And the problem with that is if you're wrong, I mean, there are people who've been in cash since 2013 telling us exactly the thing that Professor Shiller said last week. And the cost of staying out of the market often is greater than whatever you might benefit by staying out of the next crash.
Yeah, and do you see a crash coming, by the way? We're just talking like, hey, if there's a crash, I mean, is there a possibility of that?
There's always a correction coming. It's only a matter of time. When you've been doing well for a decade, there's always going to be a correction coming. The real question you have to ask yourself is it worth it to actually reallocate your portfolio to try to avoid that correction when you don't know when it will come and how it will come and what form it will take? I have never been able to make that prediction solidly enough to start to reallocate my portfolio. Maybe there are others who are better at timing the market than I am, so I'm not going to stop other people from making their own judgments. But for me, market timing has never worked.
Aswath Damodaran of the NYU Stern School of Business. Aswath, a real pleasure to get your views of the markets and Tesla. Thank you very much. We'll chat with you again.
Thank you. Take care.
Take care, folks. And thank you for watching Trading Nation. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.